Have you ever, scrolled through your banking app, maybe seen your savings yield dip a bit, or perhaps you've been eyeing that dream home only to just sigh at the mortgage rates going up?
Yeah, or maybe you're trying to pay off a credit card and the interest just feels like this constant uphill battle.
Exactly. These financial shifts, they aren't random. They're often connected by this really powerful, frequently misunderstood force right at the core of our economy.
You're absolutely right. And, economic news can feel like it's almost deliberately designed to be inaccessible. It's full of this impenetrable jargon, things like quantitative easing or yield curve inversion.
Right, stuff that makes your eyes glaze over.
Totally. We hear about the Fed and interest rates constantly on the news,
Yeah.
but really getting what those terms mean for your everyday budget, your savings, your ability to borrow money, that's a whole different thing.
And our listeners, they want to be informed, right? They want to understand these fundamental drivers without needing to spend like hours digging through dense economic white papers.
Exactly. They want the real story, but in plain English.
Hey, that's precisely our mission today. We're launching into a deep dive, looking into something called the federal funds rate. Okay, yes, it sounds technical, maybe even a bit dry,
A little bit.
but trust us, this isn't just academic talk. It is arguably the single most critical driver of economic activity in the U.S., and it directly impacts your wallet, your financial future.
So we're going to unpack the federal funds rate today, explain exactly what it is, nice and simple, show you precisely how it works its magic, and crucially, illustrate its direct, tangible influence on your financial decisions.
Think of this as your definitive shortcut to understanding a fundamental piece of what we like to call Plebonomics economics, made simple and truly accessible for, well, for the common person.
Love that. Plebonomics. So let's start right at the beginning then. What is this federal funds rate?
Yeah, let's break it down.
Okay. At its absolute core, the federal funds rate, or often just the Fed funds rate, is the interest rate at which banks here in the U.S. lend money to each other.
To each other.
Not to us.
Not to us.
Not directly to consumers, no. This isn't your 30-year mortgage or a car loan. These are usually super short-term loans, typically just overnight.
Overnight. Wow.
Yeah. And an important detail you'll often hear mentioned is that they're made on an uncollateralized basis.
Okay, hold on. Uncollateralized basis. What does that really mean? Is it just a fancy term for no collateral, or is there more to it?
That's a great question. It's actually key to understanding the sort of trust that's built into the banking system. When we say uncollateralized, it means exactly that. These loans are made without the borrowing bank putting up any assets like securities or property as security.
So like lending your friend $20 without asking for their watch.
Exactly like that. It's based purely on the borrowing bank's creditworthiness and its reputation. It says a lot about the stability they expect within the system itself.
Okay, so if banks typically have, tons of money, why are they borrowing from each other overnight? It seems a little circular. What's driving this?
Ugh. The driver here is a really fundamental banking rule. It's called reserve requirements. See, banks aren't allowed to lend out every single dollar their customers deposit.
Right, they have to keep some on hand.
Precisely. The Federal Reserve legally requires them to hold a certain percentage of their customers' deposits as reserves, and they keep these in an account at a Federal Reserve Bank. Think of it like a minimum balance you just can't dip below.
Okay.
Now, throughout any business day, money is constantly flowing in and out of a bank, right? Deposits, withdrawals, electronic payments, all that stuff.
Sure. Millions of transactions.
Millions. So a bank might end the day with more money in its reserve account than legally required. That means it has excess reserves. Good for them.
Lucky bank.
But another bank might end the day with a shortfall. Maybe they lent out a bit too much or had a lot of withdrawals. Now they have less than what's legally required in their reserve account.
I see. So the bank with the shortfall needs cash, to meet that legal minimum before the day officially closes.
Exactly. And rather than going through maybe more complex or expensive options, like borrowing directly from the Fed's discount window, which we'll touch on later, or selling off assets quickly.
It's just easier and faster to borrow from another bank that happens to have extra cash sitting there.
Precisely. So banks with excess funds lend to banks with shortfalls overnight. It's an incredibly efficient way for the system to balance itself out. It helps everyone meet these legal obligations.
And the banks with excess funds don't want that money just sitting idle, earning nothing, right?
Well, historically, they didn't earn much on it at the Fed, though that's changed a bit with the tools like IORB, which we'll get to. But yes, lending it out overnight, even at a small rate, is better than nothing. and the interest rate they negotiate for these specific overnight loans. That's what we call the federal funds rate.
And when I hear about the effective federal funds rate, or EFFR, what's that?
That's simply the weighted average of all those countless overnight interbank transactions from the previous business day. It gives you a real-time snapshot of the actual average cost of this overnight borrowing across the system.
Okay. So it sounds like this really technical thing just between banks. But you said earlier it's a cornerstone of U.S. monetary policy. How does it jump from banks lending overnight to affecting, well, everything else?
That's the fascinating part. While it starts as this interbank rate, its significance is just massive. It's often called a key driver of economic activity and a really important benchmark in financial markets. It fundamentally sets the base cost of money.
So who actually sets this rate? If the banks are negotiating it daily, who's pulling the strings overall?
Great question. While the actual transactions happen between individual banks setting the effective rate, the target for this rate isn't decided by them. The entity behind the wheel steering this incredibly important rate, that's the Federal Open Market Committee, the FOMC.
The FOMC. Okay, I've definitely heard that acronym.
Yeah, they're the main policy-making body of the Federal Reserve System. They're the ones who deliberately set the target interest rate range for the federal funds rate. Not the exact rate, but a target band they want the effective rate to trade within.
And they don't just, like, pick these numbers randomly, I assume?
Oh, absolutely not. The FOMC has a very structured, very data-driven approach. They meet regularly 8 times a year, about 7 weeks apart, to make these crucial decisions.
2 times a year. That's pretty frequent.
It is. And it's vital to remember they can and do hold additional unscheduled meetings if economic conditions suddenly change or warrant a more urgent response. Think back to early 2020.
Right, during the pandemic crisis, they didn't wait for the next scheduled meeting then.
Exactly. They're constantly monitoring the economic dashboard, like pilots checking instruments ready to adjust course if needed. Their decisions aren't arbitrary at all.
So what are they looking at? What data points?
They adjust the target rate based on a meticulous examination of a whole range of key economic indicators. We're talking crucial data like the core inflation rate that strips out volatile food and energy costs to get a clearer trend.
Okay.
They also pore over things like the durable goods orders report, which signals business investment and manufacturing activity. And of course, employment figures, job growth, unemployment rates, consumer spending habits, housing market trends, even global economic developments.
Wow, it's a lot. So they're trying to gauge the overall health of the economy, its momentum.
Exactly. Is it growing too fast and risking inflation? Is it slowing down and risking unemployment? These reports offer vital clues about the country's economic health and its likely direction.
So when the FOMC makes a decision, it's a really big deal.
Huge deal. Their announcements are incredibly significant and widely followed by the non-financial press. You know, your local news, major papers, financial websites, everyone reads. That's because these decisions have far-reaching economic consequences.
I remember back in December 2024, when the Fed cut the rate by 25 basis points. Hang on, basis points. Can we quickly clarify that?
Good point. Yeah, you hear that term a lot.
Yeah.
1 basis point is just 1/100th of a percentage point. So 25 basis points is 0.25%, or 1/4 of 1%. 100 basis points is a full percentage point.
Got it. So that 1/4% cut back then, it made headlines everywhere. It wasn't just some obscure financial news.
Exactly. People inherently understood it would eventually impact them directly. And that, my friends, brings us right to the heart of Plebonomics, how this rate actually touches your wallet.
Yes, the ripple effect. Let's dive into that. How does this rate between banks translate to my mortgage or my credit card?
Right. This is where it gets really compelling. While it might start as an overnight rate between banks, it truly is one of the most important interest rates in the entire U.S. economy because it influences that wide range of market interest rates that directly affect you and me.
So it sort of sets the tone for all other borrowing?
It essentially impacts the broader monetary and financial conditions across the board. It sets the stage for how expensive or cheap money is throughout the whole system.
Okay, let's talk specifics. The big one first. Borrowing costs, especially for major things like buying a home. Let's say our listener, Sarah, is saving for her first house.
Perfect example. Mortgage rates often move in tandem with the federal funds rate. They don't track it perfectly day by day, but the trend is very strong. So if the Fed raises the federal funds rate target,
Sarah's potential mortgage could become significantly more expensive.
absolutely. Over the life of the loan, say a 30-year mortgage on a $400,000 house, even a 1/4 point increase, just 25 basis points, could add literally tens of thousands of dollars to the total interest she pays.
Wow. Tens of thousands. That's huge.
It's massive. This direct link is a major reason the Fed funds rate makes national news headlines. It's not just abstract economics, it's about whether Sarah can afford her dream home, whether it stays within her budget.
And it's not just mortgages, right? What about other debt? Credit cards?
Oh, definitely. Think about credit card balances. For many households, that's the highest interest debt they carry. Those sky-high rates you see advertised, they are incredibly sensitive to the federal funds rate.
So when the Fed raises rates, my credit card company likely raises my rate too.
That's generally how it works, yes. Credit card rates and personal loan rates are influenced by changes in the federal funds rate. When the Fed rate goes up, the bank's cost of funds effectively goes up, and they pass that increased cost onto consumers pretty quickly, especially on variable rate products like credit cards.
Leading to higher interest on your debt, making it even harder to pay down that balance each month.
Exactly. It can trap people in a cycle of minimum payments.
Okay, what about buying a car? Let's say our listener, Mark, needs a new vehicle.
Same story, and unfortunately for Mark if rates are high. Car loan rates typically follow trends in the federal funds rate, impacting vehicle sales. The Fed's decisions directly affect how much Mark pays each month for his car loan.
Which could make the difference between affording that reliable new sedan or having to settle for something older, maybe less reliable.
Precisely. And this ripple effect doesn't stop there. It also extends to personal loans. Maybe you need one for a home repair or debt consolidation, and even student loans, especially private ones or variable rate federal ones. All of these become more or less expensive depending on where the Fed sets its target.
So why does this happen so broadly? Why do all these lenders seem to follow the Fed's lead?
It's because lenders, including your local bank or credit union, often base their own lending rates on something called the prime lending rate.
The prime rate. I've
Right.
heard of that too.
Right. The prime rate is typically the rate banks charge their most creditworthy borrowers, usually large corporations, and the prime rate itself is heavily directly influenced by the federal funds rate. It usually moves almost in lockstep. Often prime rate equals the top of the Fed funds target range, plus about 3%.
Okay, so Fed funds rate influences the prime rate.
Which then influences the rates offered to the rest of us for mortgages, car loans, credit cards. Think about it simply. If a bank can earn, let's say, 4.5% by lending money safely overnight to another bank in the federal funds market.
They're certainly not going to lend money to me for 30 years on a mortgage, which is way riskier for less than that.
Exactly. They're certainly not going to settle for less than that for riskier, longer-term loans to consumers or businesses. They need to build in a profit margin and account for the risk of default. So the federal funds rate acts as this fundamental baseline, this floor or gravitational pull for almost all other interest rates in the economy.
But it's not all bad news for us when rates go up.
Right.
What about the other side of the coin savings? Let's think about our listener, Emily, who's diligently building her retirement nest egg.
That's a crucial counterpoint, absolutely. It's not just about borrowing. The federal funds rate also directly impacts your savings. And this can be good news. When the Federal Reserve raises the federal funds rate, it generally leads to higher yields for savers and better rates for CD investors and bank accounts.
So my savings account might actually start earning more interest.
Yes. Your hard-earned cash can start to work a bit harder for you. If you're saving for a down payment, child education, retirement, whatever higher interest rates mean, your savings grow faster.
That's definitely welcome news for savers.
Conversely, though, if the Fed lowers the rate, then deposit account interest rates will fall too. This means the annual percentage yields, the APYs on things like certificates of deposit, CDs, regular savings accounts, money market accounts, even interest-bearing checking accounts will likely decline.
So borrowing might get cheaper, but the money I'm saving won't grow as quickly.
Exactly. It cuts both ways. As Banklade's chief financial analyst, Greg McBride, points out, holding rates steady, like the Fed is doing now, is often music to the ears of savers, like retirees, that are earning good income on their hard-earned savings. They can continue benefiting from those relatively higher yields for a while longer.
Okay, so direct impact on borrowing and saving. What about broader economic impacts? Things that affect our everyday lives, maybe less directly. Jobs, for instance.
Absolutely. Let's talk business investments and jobs. When the federal funds rate is low, it makes borrowing cheaper not just for us, but for businesses too.
Right, easier for them to get loans.
Which spurs business expansion and capital investments. Think of a local small business, maybe owned by our listener Maria, finally getting that affordable loan to buy new equipment or open a second location, or a large corporation investing in a huge new factory.
And those investments create jobs.
That's the idea. Cheaper money encourages investment, which can lead to job creation and overall economic growth. On the flip side, higher rates generally curb such activities. Businesses might pause expansion plans, hold off on big investments, which can slow down hiring and overall economic momentum.
What about the stock market? People watch that closely, especially for their 401ks and retirement accounts.
The stock market is definitely affected. Investors, from individuals like us checking our retirement balances to huge institutional funds, pay very close attention to the federal funds rate. Why? Because it has an impact on the stock market.
How so?
Well, generally speaking, lower interest rates can be seen as positive for stocks. A small decline in the Fed funds rate can sometimes prompt the market to leap higher as the borrowing costs for companies get lower.
Because cheaper borrowing means potentially higher profits for companies.
That's the logic. If companies can borrow more cheaply, their future earnings might look better, making their stocks seem more attractive. This directly affects your retirement savings, your 401ks, any investments you hold.
But is it always that simple? Does a rate cut always mean stocks go up?
Not necessarily. The market reaction can depend on why the Fed is cutting rates. If they're cutting because the economy is strong and inflation is under control, that's usually good. But if they're cutting because they fear a recession, well, the market might react negatively to the underlying economic fear.
Context matters.
Context is everything. And astute investors need to discern if a market rally is fueled by genuine economic strength or just by the temporary sugar high of cheap money. That's key for long-term investing.
Okay, and one last big area. Inflation. The cost of everyday goods and services. How does the Fed funds rate fit in there?
This is arguably the ultimate overarching goal behind many of the Fed's actions, especially recently, controlling inflation. When the Fed raises rates, it aims to reduce overall demand in the economy.
How does raising rates reduce demand?
Think about it. If it's more expensive to borrow money for that mortgage, that car, that business expansion, people and businesses tend to borrow and spend less, they might save more instead.
Okay, so spending slows down.
Exactly. And the slowdown in overall demand then helps to cool down price pressures. It causes prices to subsequently fall, or at least slow their rate of increase. This helps protect your purchasing power.
So my dollar goes further at the grocery store.
That's the goal. It ensures that the cost of your daily essentials, from groceries to gas to rent, doesn't spiral out of control. It's all about maintaining that stability so your hard-earned money retains its value.
Which brings us to why the Fed changes rates at all. You mentioned this delicate balancing act.
Exactly. It's not arbitrary. The Federal Reserve's main job is to promote a healthy economy. But, and this is key, unlike many other central banks around the world, its goal isn't just to stabilize price growth, control inflation.
There's something else.
Yes. It's also explicitly tasked by Congress with maintaining maximum employment. This is known as the Fed's dual mandate.
Dual mandate.
Right.
Stable prices and maximum employment. Those sound like they could sometimes conflict, right?
They absolutely can and often do. That's the core tension. Trying to achieve both simultaneously is the constant challenge.
So let's talk inflation again. We know it's when prices go up overall. Think about our listener, David, noticing his grocery bill climbing week after week while his paycheck stays the same.
That's inflation hitting home. And while a little bit of inflation, say around the Fed's official target of 2% per year, is generally considered normal, even healthy for a growing economy.
Too much is bad news.
Right.
Too much unexpected inflation can erode purchasing power, hurt savers, because the money they save buys less, and create uncertainty that slows down economic growth. Nobody wants their money to constantly lose value. It undermines financial security for everyone.
Okay, so the Fed has this dual mandate. How do they actually do it? You said the FOMC sets a target range. How do they make the actual effective rate stay within that range? They don't just announce it and hope for the best, right?
No, they have some powerful tools in their toolkit to push the effective federal funds rate into that target range. They don't just wave a magic wand.
What are these tools?
The primary tool these days, the one that really sets the floor for rates across the banking system, is called interest on reserve balances, or IORB.
IORB. Okay, what's that?
It's quite literally an interest rate the Fed pays to banks for the funds they hold in their reserve accounts at the Fed.
So the Fed pays banks interest on the money they're required to keep there anyway. Exactly. And on any excess reserves they hold there too. Imagine you're a bank with extra cash. The Fed offers you a completely safe place to park it, and they pay you interest on it, the IORB rate.
Ah, so why would a bank lend money to another bank overnight for less than they could get, risk-free, just by leaving it at the Fed?
Precisely. They generally won't. So the IORB rate effectively creates that floor, that bottom boundary, for the federal funds rate.
Okay, that makes sense. What else?
Then there's the overnight reverse repurchase agreement facility, often called the on-RRP facility.
That sounds complicated.
It does, but the concept is similar. It basically expands the Fed's reach beyond just traditional banks. It allows a broader range of financial institutions, think money market funds, government-sponsored enterprises, institutions that might not have accounts at the Fed to earn IORB. It allows them to essentially lend money to the Fed overnight, secured by Treasury securities, and earn interest at the on-RRP rate. This further helps to ensure a floor for the federal funds rate, pulling more pools of cash into alignment with the Fed's target and ensuring short-term money markets stay stable.
So IORB and on-RRP help set the floor. Is there anything setting the ceiling?
Yes, traditionally that role is played, at least partially, by the discount rate. This is the interest rate at which the Fed itself lends money directly to eligible banks and other depository institutions through its discount window.
So banks can borrow directly from the Fed.
Yes, it's meant more as a backup source of funding, a safety valve for the system. Banks are generally expected to try the Fed funds market first. Because borrowing from the discount window might signal some financial stress, banks are often reluctant to use it unless necessary.
And the discount rate is usually set higher than the Fed funds target rate.
Typically, yes. It's set a bit above the top of the target range for the federal funds rate. Since banks are unlikely to borrow from each other at rates significantly higher than they could borrow directly from the Fed, the discount rate acts as a sort of effective ceiling on the federal funds rate.
Floor and ceiling. Got it. Any other major tools?
The other classic and still crucial tool is open market operations, or FOMO. This is the buying and selling of government securities, like U.S. Treasury bonds, by the Fed in the open market.
How does buying and selling bonds affect interest rates?
It's all about the money supply in the banking system. When the Fed buys securities from banks, it pays for them by crediting the bank's reserve accounts. This injects money into the banking system, adding liquidity.
More money available to lend.
Exactly.
Right.
And when there's more supply of money available to lend, basic economics says the price of borrowing that money, the interest rate tends to go down.
Okay. And when the Fed sells securities?
It's the opposite. Banks pay the Fed for those securities, so money flows out of their reserve accounts into the Fed. This removes money from the banking system, reducing the money supply or draining liquidity.
Less money available to lend.
Right, which tends to push interest rates up. This tool is really essential because without sufficient liquidity in the system, the other tools Fed uses become ineffective. You need that smooth flow of cash for IORB and the discount window to function properly.
Okay, so those are the tools. Now, when and why does the Fed decide to use them to push rates up or down?
It comes back to that dual mandate in the state of the economy. When the Fed wants to stimulate economic growth, maybe the economy is sluggish, unemployment is rising, or there's a risk of recession, they lower the target federal funds rate.
Make borrowing cheaper.
Exactly. Cheaper borrowing throughout the economy encourages both consumer spending and investment. Our listener, Maria, the small business owner, maybe that cheaper loan means she finally expands, hires more staff, buys that new tech. It can help kickstart an anemic economy.
And we saw this happen dramatically during the 2008 financial crisis, right? Rates went practically to zero.
They did. They dropped rates to a record low target range of 0% to 0.25%.
Yeah.
And they did it again in March 2020 during the initial COVID lockdown. These were emergency measures to inject life into stalling economies.
Okay, so that's lowering rates to stimulate. What about the opposite, raising rates?
The Fed raises the target rate when it wants to cool down an overheating economy, or, more commonly these days, when it wants to combat inflation.
Like we saw from 2022 into 2024.
Exactly. When inflation is running too high, making everything more expensive, the Fed raises rates. This makes borrowing more expensive, which encourages saving and reduces spending.
So it taps the brakes in the economy.
Precisely. If it costs more to borrow, consumers and businesses pull back on spending and investment. This slowdown in demand helps ease those price pressures. The aggressive rate hikes we lived through recently were a direct response to combat that high post-pandemic inflation.
And what if things are just okay? Not too hot, not too cold.
then the Fed might choose to hold steady. In periods of relative economic stability, or maybe when there's heightened uncertainty about the economic outlook, like perhaps right now the Fed may choose to keep the rate unchanged.
A wait-and-see approach.
Exactly. It allows them to observe more data, assess how previous actions are working before making their next move. It's like a cautious driver at a complex intersection, just waiting for the signals to become clearer before proceeding.
It really does sound like a complex and delicate balancing act, because raising rates to fight inflation, that can slow the economy down too much, right? Maybe even cause job losses.
That's the inherent trade-off, yes. Raising rates to fight inflation will generally slow growth and increase unemployment. Conversely, lowering rates too aggressively to support jobs can risk fueling more inflation.
Damned if you do, damned if you don't, almost.
It can feel that way. The Fed has to weigh these factors very carefully, meticulously looking at that whole dashboard of data. Inflation trends, job numbers, consumer spending, business investment. It's like steering a giant, complex ship through constantly shifting economic seas, always trying to keep it on an even keel, aiming for that dual mandate.
Okay, let's bring it right up to today then. What's happening now with the federal funds rate? We're recording this in late June 2025.
Right. So as of the Fed's last meeting on June 18th, 2025, they maintained its policy interest rate range of 4.25%. 4.50%.
Holding steady.
Holding steady. And this marks the fourth meeting in a row that the FOMC has paused rate changes. So for nearly half a year now, rates have been stable in that range.
And just to give that some context, they had cut rates before that pause, right? In late 2024.
That's right. The Fed cut rates by a total of 1 percentage point or 100 basis points in the second half of 2024. So this current range, 4.25% to 4.50%, has actually been in place since the December 2024 meeting.
So a period of cuts and now a period of holding steady. Was this expected?
Yes, this widely anticipated outcome reflects that wait-and-see approach we just discussed. The official statement mentioned influences like resilient economic data, lingering above target inflation, and tariff uncertainty.
Tariff uncertainty, that sounds important.
It seems to be a key factor right now. The statement also noted that uncertainty about the economic outlook has diminished but remains elevated. So they're still cautious.
Did they give any hints about the future? What are their projections saying?
They did. Alongside the rate decision, the Fed provides updated economic forecasts in their Summary of Economic Projections, the SEP. It gives us a glimpse into their thinking.
What did the latest SEP show?
Well, a few things. Their median projection for 2025 economic growth actually declined slightly to 1.4% from 1.7% back in March, so a slightly slower growth outlook.
Okay. What about inflation?
That's the tricky part. Core inflation projections actually increased to 3.1% from 2.8%. So they see inflation being a bit more persistent than they did a few months ago and still well above that 2% target.
And unemployment.
Unemployment estimates also increased slightly to 4.5% from 4.4%. So overall, the picture is one of slightly slower growth, slightly higher unemployment, and inflation that's proving stubborn.
Not exactly a clear signal for rate cuts then.
Yeah.
What did Fed Chair Powell say about all this?
Despite these somewhat mixed projections, Fed Chairman Jerome Powell stated that the Fed remains in a good position to exercise patience before changing rates. He pointed to a still solid U.S. economy and noted only narrow signs of higher prices in a subset of goods, suggesting maybe broad inflation isn't accelerating wildly.
And he mentioned the tariffs again.
He did. He specifically indicated that the Fed expects to learn a great deal more about the impact of recent and potential tariffs, and that this information will significantly inform future decisions. That seems to be a major wild card they're watching.
It's worth remembering how far inflation has come down already, though,
Yeah.
right?
Absolutely. It's important context. Those aggressive rate hikes from 2022 to mid-2023 did work. They drove the Fed's preferred inflation gauge, the core PCE index, down from a peak above 5.5% year over year in 2022 to 2.5% in April of this year.
So significant progress, but not quite mission accomplished back to 2% yet.
Exactly, which likely explains the current patience and caution.
So what are people expecting next? Our listener, John, who follows the markets, what are investors thinking?
Well, right now, investors are generally anticipating 2.25% rate cuts in 2025. So 2 quarter-point cuts by the end of this year. Interestingly, that's actually in line with the Fed's own updated median projections from the SEP.
But you mentioned uncertainty. Has that expectation been steady?
Not at all. Investor sentiment has really fluctuated throughout the year, largely due to that tariff uncertainty and mixed economic data. Earlier in the year, expectations for cuts were much more aggressive.
What about the Fed officials themselves, that famous dot plot?
Yes, the dot plot. It's a chart showing where each individual FOMC member anonymously expects the federal funds rate to be at the end of the year and in future years. The latest one from the June meeting, reflecting expectations for year-end 2025, showed the median member projecting rates around 3.9%, which implies about 2 more quarter-point cuts from the current level by year-end.
So the median expects cuts, but is everyone on the same page?
Definitely not. There's clear division among the policymakers, which really underscores the uncertainty. Looking at projections for the rest of this year, 2025, based on the June meeting, 7 out of 19 policymakers forecasted 0 cuts this year, while 2 others say a single 0.25 percentage point cut is likely.
Wow, so a significant chunk thinks they might not cut at all this year.
Exactly. It highlights the lack of consensus within the Fed itself about the immediate path forward. And again, Chairman Powell emphasized that a primary reason for holding off is to understand what will happen with the tariff inflation.
And there's a deadline related to tariffs coming up soon.
Yes, President Trump's 90-day pause on reciprocal tariffs ends July 9. So the thinking is that more crucial data on global trade impacts and potential price effects will emerge over the summer, which should help guide the Fed's next decision.
Speaking of which, when is the next meeting?
The next scheduled FOMC meeting is July 29-30, 2025. That's when we'll likely get the next official decision and updated commentary.
Though, as you said, they can act between meetings if needed.
They can, although it's less common unless there's a significant economic shock.
Okay, so putting it all together, holding steady now, uncertainty about cuts, tariff questions.
Yeah.
What does this mean for our listeners' money right now? For Sarah, Mark, Emily, David, Maria.
Let's break it down. For borrowers like Sarah paying off student loans or Mark thinking about that car, the message is pretty clear. With the Fed keeping rates steady, it's unlikely that borrowers will see near-term relief on their lending costs.
So no quick drop in interest rates for credit cards, personal loans, car loans.
Probably not. This underscores the urgency for borrowers to aggressively pay down high-cost credit card debt because that relief isn't likely coming soon. The current environment offers little hope of a significant drop in interest rates anytime soon. Existing variable rate debt will likely remain expensive.
Okay, that's tough news for borrowers. But what about savers? Like Emily building her retirement funds or David putting money aside?
Here, the news is better. As Greg McBride said, the current steady, relatively high rates are music to the ears of savers, like retirees, that are earning good income on their hard-earned savings.
So savings accounts, CDs, money markets should continue offering decent yields for now.
That's the expectation, yes. While rates might eventually come down, the current pause means savers can continue to benefit from these more attractive yields compared to the near-zero rates we saw just a few years ago. So if you're a saver, this stability is actually a good thing, allowing your money to grow more effectively.
It really highlights how Fed policy creates winners and losers, or at least different impacts depending on your financial situation.
Absolutely. It's rarely uniform across the board.
Now let's zoom out a bit. How does the U.S. Fed's stance compare globally? Are other countries doing the same thing?
That's a great point. The U.S. Federal Reserve currently remains an outlier among many major central banks. While the Fed is holding steady, several other major central banks have cut rates multiple times this year. We're talking about the Bank of England, the European Central Bank, ECB, the Bank of Canada, the Reserve Bank of Australia. Many have already started easing policy, cutting rates.
So the U.S. is holding rates higher while others are cutting. What does that do?
It indicates a generally easier monetary policy stance globally compared to the U.S. This divergence can have significant implications for international investment flows and currency values.
How so? International investment flows.
Well, think about global investors looking for the best return on their money. A relatively high federal funds rate in the U.S. can make investments within the United States, like U.S. Treasury bonds, or even just holding U.S. dollars more attractive compared to countries where rates are lower.
So money flows into the U.S.
It can, yes. It acts like a magnet for global capital when U.S. rates are comparatively high. Conversely, if the federal funds rate were very low, it might make investments in developing countries such as China or Mexico more attractive as investors seek higher yields elsewhere.
And what about the value of the dollar?
Rate differentials definitely affect currency values. A higher U.S. interest rate relative to other countries tends to strengthen the U.S. dollar.
Why does that happen?
Because global investors need to buy U.S. dollars to invest in those higher-yielding U.S. assets. Increased demand for dollars pushes its value up relative to other currencies.
And a stronger dollar has consequences for trade, right?
Big consequences. A stronger dollar makes U.S. exports more expensive for other countries to buy, which can hurt American companies selling goods abroad. But on the flip side, it makes imports cheaper for us, which can help keep inflation down for imported goods and benefits U.S. consumers buying foreign products.
It can also affect other countries' currencies. You mentioned the Mexican peso.
Yes, a significantly stronger dollar can put pressure on currencies like the peso, potentially making imports more expensive for Mexico or making it harder for Mexican businesses or the government to repay any debt they hold in U.S. dollars. It creates ripples across the global economy.
It's amazing how interconnected it all is. Now, looking back historically, has the Fed funds rate always been in this sort of, 4 or 5% range we see now? Or has it been wildly different?
Oh, wildly different. The target for the federal funds rate has varied widely over the years in response to whatever economic conditions prevailed at the time. It hasn't been a smooth ride at all.
How high has it gone?
Get this. It was set as high as 20% in the early 1980s.
20%. Can you imagine a mortgage at over 20%?
It's almost unthinkable today. This was under then-Fed Chair Paul Volcker, who took drastic measures to combat rampant double-digit inflation that was crippling the economy. It caused a painful recession, but it ultimately succeeded in breaking the back of that inflation cycle.
Wow. Okay, so that's the high. What about the lows?
The other extreme. It was slashed to a record low target of 0% to 0.25% following the 2008 financial crisis. That near zero range was an unprecedented move to stimulate growth, and it stayed there for a long time, from December 2008 all the way to December 2015.
7 years near zero.
7 years, and then it returned to that same near zero range again in March 2020 at the start of the COVID-19 pandemic, again as an emergency measure to try and keep the economy afloat.
So we've seen both extremes in relatively recent history, and then the climb back up.
Exactly. After sitting near zero for 2 years during the pandemic, from March 2020 to March 2022, the rate steadily climbed starting in March 2022, and it climbed aggressively.
Those are the big hikes, right? 0.75 percentage points at a time?
Yes, multiple 0.75 percentage point or 75 basis point hikes in 2022. That was the Fed hitting the brakes hard to combat that surging post-pandemic inflation. This climb continued into early 2023, pushing borrowing costs up very quickly.
And then the pause starting mid-2023, followed by the cuts in late 2024 we mentioned earlier.
Right. After holding rates steady in the 5.25%, 5.50% range from July 2023 to July 2024, the Fed began cutting in the latter half of 2024. A 50 basis point cut in September, then 25 basis point cuts in November and December.
Bringing us to the current 4.25%, 4.50% range where they've paused again.
Exactly. So a period of near zero, a rapid climb, a high plateau, some modest cuts, and now another pause. It reflects the very dynamic and challenging economic environment of the past few years.
Okay, that history is fascinating. It leads to a question many people probably wonder about, especially during election years when politicians talk about the economy. Who's really in charge? Can the president, for example, just tell the Fed to lower interest rates?
That's a really common misconception and a crucial point to understand. Even if the U.S. president has pledged to lower interest rates, maybe during a campaign, that decision is out of his direct control.
So the president can't just call up the Fed chair and say, cut rates.
Nope. The FOMC, which actually sets the federal funds rate target, is designed and structured to be a non-political entity and operates independent of the president. This independence is considered vital.
Why is independence so important?
It's designed to shield monetary policy decisions, which can sometimes be unpopular in the short term, like raising rates to fight inflation from short-term political pressures or election cycles. The idea is to allow the Fed to make decisions based on the long-term health of the economy, not political expediency. Crucially, a president has no legal authority to remove the Fed chair before the end of their appointed term, except for specific cause, which is very rare.
But surely the president has some influence.
Oh, absolutely. It's indirect, but it's there. First, the president appoints the Federal Reserve Board officials, including the chair and vice chair, subject to Senate confirmation. For example, President Trump nominated Jerome Powell back in November 2017. So over time, a president can shape the overall philosophy and makeup of the Fed's leadership.
So they pick the players, but can't call the plays day to day.
That's a good way to put it. Second, the president can take executive actions that impact the economy, including inflation and growth. Think about trade policy, regulations, things like that. The Fed then has to react to the economic consequences of those actions.
And fiscal policy, taxes and spending.
Exactly. The president can influence Congress to create fiscal policy, major spending, and tax legislation. These have huge economic effects, changing demand, potentially impacting inflation and growth. The Fed's monetary policy then has to operate within the context set by that fiscal policy. So it's not direct control over the rate lever, but a complex interplay of influences.
Okay, that clarifies the independence question. So zooming out one last time, can you just briefly sketch out the overall structure of the Federal Reserve itself? Who are all these parts?
Sure. At the top, you have the Federal Reserve Board, often called the Board of Governors, based in Washington, D.C. It's the main umbrella agency that governs the Federal Reserve System.
The governing body.
Right. And under that umbrella, the system has sort of three main pillars or groups working together. First, there are the 12 regional Federal Reserve banks located in major cities across the U.S. New York, Chicago, San Francisco, Atlanta, etc. Each serves the banks in its specific district.
Okay.
The regional banks. Second, there's the Board of Governors itself, which we just mentioned, providing national oversight. And third, there's the Federal Open Market Committee, the FOMC, which we've spent most of our time talking about today.
And the FOMC is made up of?
The FOMC includes the 7 members of the Board of Governors, the president of the Federal Reserve Bank of New York, who always has a vote, and presidents of 4 other regional Fed banks who serve on a rotating basis. It's this committee that holds those 8 scheduled meetings a year to set the target for the federal funds rate.
All working towards those mandates Congress gave them.
Exactly. The entire Federal Reserve System, through these different parts, is responsible for achieving its 3 congressional mandates: maintaining maximum employment, ensuring steady prices on goods and services, price stability, and promoting moderate long-term interest rates throughout the country. Those are the guiding stars for everything they do.
And there you have it. Wow. We've really peeled back the layers on the federal funds rate today. We took this thing that sounds maybe obscure or technical,
It really sounds technical.
and hopefully made it crystal clear just how vital it is.
Yeah.
You now know that this interbank rate, the actual price banks pay to borrow from each other overnight, is the fundamental lever the Federal Reserve uses to influence the cost and availability of money throughout the entire U.S. economy.
And it's not just theoretical. From your mortgage payments and your credit card bills to the interest you earn on your savings, maybe even the stability of your job, the Fed's delicate balancing act between managing inflation and maximizing employment directly affects your financial life in very real, very tangible ways.
Understanding this key economic indicator, this cornerstone of Plebonomics, really empowers you to make more informed financial decisions. It helps you anticipate potential changes in borrowing costs, maybe spot opportunities for your savings, and just generally comprehend the bigger economic currents that are shaping your financial future.
It's about taking control by understanding the forces at play.
Exactly. So with the Federal Reserve currently taking this wait-and-see approach, holding rates steady, and with that clear division among its own policymakers about what happens next with rate cuts, we want to leave you with this final thought to ponder.
How might your personal financial strategy, your saving, your borrowing, your investing need to shift if the economic data surprises everyone? If inflation suddenly drops faster than expected or maybe spikes again due to those tariffs? What if the path for interest rates turns out very different from what the projections currently suggest?
It's something crucial to think about as you continue navigating your own financial journey in these uncertain economic times.